Well, hey there, everyone. Welcome to Chart This with Dave Keller. Happy Monday, October 13th. I'm your host, Dave Keller, coming to you from a kind of cool but comfortably autumn-like Redmond, Washington. Thanks so much for joining me here on the show. Every trading day after the close, we debrief on the markets using the best practices of technical analysis, behavioral finance, mindful investing strategies, whatever we can throw in. But the goal here is threefold. Number one, just sort of inform you, update you on what's happened in the markets today. If you've been following the markets, which you probably have to some degree, hopefully this just gives you a quick recap of some of the key moments or key outcomes that stood out to me, having analyzed the markets for a couple of years by now. Number two, to help you understand the general complexity of the market, the macro side, all the way down to the micro side, focusing on individual stocks and groups on the move, and then focusing on charts and how we can use technical analysis to better understand the environments around us, to manage risk, to identify opportunities, all of the above. The Mariners starting game 2 against the Blue Jays. Dramatic victory last night. If you pick up the joy on my in my voice, that's what that's from. So hopefully they're actually starting here momentarily. I do not have the game on. I have it paused. As soon as we're done, I'm going to go get it started. Let's talk about charts, and then we'll go on from there. So nice recovery day, right? Friday, sort of a big sell-off. If you remember, we did a mailbag episode on Friday. Instead of going right into the mailbag, we did spend a little bit of time on Friday midday, sort of just checking in on what was happening. The market accelerated into the lows of the day and really finished in a position of weakness, literally touching our line in the sand at 65.50, right around the close. As we shared with our Market Misbehavior Premium members over the weekend in our weekly report, which is our main sort of investment-oriented report for our premium members, we talked about how after a sell-off you've seen, like you saw on Friday, given the fact that we've been in a primary uptrend for so long, given the fact that there's been limited pullbacks, given the fact that it accelerated into the close on Friday, most likely kind of the classic playbook after the weekend is a brief bounce higher. You can call that a dead cat bounce. You can call that a recovery day. You can call that a lick your wounds day, whatever it was. Today sort of followed that traditional playbook pretty well. Pretty common when you have a significant move counter trend. The next day you have sort of a brief mean reversion as investors are still kind of getting their head around what happened in the previous day. So I would argue after Friday's sell-off, today is almost a throwaway day, right? Because you assume you get a brief bounce. The real action is tomorrow, right? And Wednesday, right? Tuesday and Wednesdays, if you see if buyers come in beyond just that initial kind of dead cat bounce rally like we saw today, do we see additional demand? Do we see optimism pushing the S&P back up towards 67.50 and beyond? Or are investors selling off this initial rally today? So I think the next 2 days are going to help us put our head around what actually played out on Friday and sort of the lasting implications. Having said that, a lot of red flags we've been looking for all fired, right? Credit spreads widened out, volatility spiked, breadth indicators went from not so good to really not so good. The Hindenburg omen flashed an initial sell signal on Friday. That's one we didn't get to talk about. And I'll share with you that chart and what that means. All right, enough of an intro. Let's look at what happened today. Recovery day, we'll call it. I agree. That sounds pretty good. By the way, we're live streaming on Facebook, LinkedIn, YouTube, and X. Thanks for tuning in live. Those of you that are doing so, please drop questions anywhere where you're streaming, and let me know what questions are coming up. If you're watching the show later on our YouTube channel, use the comments section there. You can ask questions anytime. And let's get started here. So the S&P, right, sort of finished mid-range, regained about a half of the sell-off on Friday. So Friday we opened around 67.50. Here are the comments from presidential administration around 11 a.m. Eastern. We can see the aggressive sell-off that really went all the way into the close. Some of the language over the weekend was a lot less negative, a little more measured. And as a result, the bounce higher literally ended up about 50% of the way back up, recovering. So we're still well below where we were. We did close around 66.54. That is good enough to be up 1.6% today on the S&P 500. The NASDAQ composite up 2.2%. The Dow up 1.3%, mids, smalls, all up about 2%. nice recovery day, right? And again, I can't tell you, having seen a lot of big sell-off kind of days, the next day is usually a brief bounce. When it's not, that's where you're in like the great financial crisis, and there's a lot of there's a lot bigger issues than just a one-day thing, right? When you have a big sell-off and then it's followed by another big sell-off day, that tells you there's a structural issue with the market, a liquidity issue, or some sort of big significant thing. What happened today is a lot more common. Volatility getting a little better, right? We can see that the VIX on Friday spiked up to just above 20. That's sort of our initial line in the sand. VIX above 20 tells us we're in a more volatile environment. Be prepared for steeper sell-offs. That basically says the options market's pricing in bigger price swings than before. The fact that we spike above there today, getting back below 20, so that's good. That's encouraging. Does it remain below 20 for more than a day? That's the big question for the VIX, right? You have a spike. You have a big spike in volatility. We saw one of those earlier, and I grabbed the chart of the VIX to show you the last big kind of sell-off that we had off the April lows. We had a similar one-day spike in the VIX above 20, and then it kind of alleviated right after that. Bond markets closed today for Columbus Day / Indigenous Peoples Day, whatever you prefer to call it. Bond market's not open today. Stocks open. So we're going to spend most of our time talking about stocks and ETFs. Keep in mind, though, no change to treasury yields, no change to bond performance because of the bond markets being closed today. The dollar index slightly higher, about 1/3% for the UUP. So the story in October has been stronger dollar, definitely stronger gold as we've pushed above $4,100 an ounce, weaker crude oil. All right, looking at the commodity space. Speaking of gold going up, here we go. GLD up 2.4% today. Silver up 4%. Copper prices up over 4%. Even crude oil moving slightly higher. So that precious metals trade remains quite strong here. I still have a decent position in GLD, IAU types of things. The only thing I've been doing is trimming those to a degree on the way up. But overall, as a trend follower, it's kind of a perfect storm of an uptrend that continues, right? And again, your goal as a trend follower, I would argue, follow those trends as long as possible. And I don't see anything on the chart of gold signaling any pause at this particular moment. I see the trend as being quite strong by using moving average techniques, the chandelier exit system, whatever you want to throw at gold, pretty constructive here. So I get nervous when it's no longer constructive. At this point, still pretty decent. Cryptocurrencies recovering a bit. You can see that over the weekend, Bitcoin sold off from around 122 down around 108. We can see today currently trading just below 116,000. That's up just slightly from Sunday's kind of closing value. Ether prices, Ripple, others you see on the top 10, all in the green today. All right, looking at the 11 S&P sectors, ended up being a recovery led by some growthy stuff here. Technology, the XLK up 2.4%, consumer discretionary up 2.2%. Then we have the cyclical sectors, materials, energy, industrials, to round out the top 5. 9 of the 11 S&P sectors finished in the green today. The only ones in negative, consumer staples down about 1/3%, healthcare, the XLV, down 0.1%. Everything else was in the green today. So while Friday was very much a move toward more defensive positioning and defensive sectors, today kind of a counter trend bounce led by some of those growth sectors. And again, after this sort of move, I would say completely reasonable and expected, given the severity and the sudden sell-off that we experienced on Friday. Does that sell-off have staying power? Do we have further distribution? This is where the tools of technical analysis become super helpful, because we can think about flows and what the price action in these different sectors implies about investors getting more defensive or maybe just rotating back to more offensive positions. Do we hit triggers? Do we break key lines in the sand, key levels of support? Do breadth conditions deteriorate? Some of those things are happening, others are not. We'll go through as many of those charts as we can here momentarily. Check in quickly on breadth. Breadth pretty good today. Breadth on Friday was absolutely disastrous, with the very bearish color making a rare appearance here on chart this, with all of these sectors showing quite a bit of distribution. Today, again, counter trend move higher on the New York Stock Exchange, 78%, 79% up. to 20% down. It's about a 4-to-1 ratio up to down. On the S&P, 71% up, 29% down. So breadth broadly positive today. Again, breadth indicators generally have been struggling September now into October, and I have a couple charts hand selected to demonstrate that rotation that's been playing out. Our market trend model, as we went through in a little more detail with our premium members over the weekend, I can't go through a lot of the detail here, but as a quick update, as of Friday's close, the short-term model was bearish on all of these indexes, from the S&P large cap to small caps, the Russell 2000, also the NASDAQ 100, the QQQ. This particular widget on stock charts does a check at the end of every trading day to see if there are any changes. We kind of decided on that just to keep it updated during the week, so we're reflecting what's happening in the market today. But the way that I use that model is every Friday after the close, I kind of lock in the new values, and I don't update it again formally until the next Friday at the close. It's meant to be a weekly process, a weekly exercise of looking at the trends on different time frames. So most recently, as of Friday's close, short-term model bearish for the S&P 500. That's only second time off of the April low that market trend model has turned bearish. I'll show you really quick just for a moment here. So here's the market trend model, and here are the 3 time frames: long-term, medium-term, short-term. Here's the April market low when it was pretty beaten down. We can see the initial rally turn the short-term model bullish in early mid-April after that April low. It did turn bearish for 1 week in late July. It did turn bearish as of last Friday. This is the current week, which again is still sort of in play. Just the second bearish signal from the short-term model off of the April low. Medium-term time frame, which is the main one that I use to think about how I'm allocated, think about risk on versus risk off, still very much in the bullish range, well above the zero line. That would be a very negative sign, would be the medium-term model turning negative. That doesn't happen often. We can see going back, it's just happened a handful of times in the last 5 years. All right, what else can I tell you here? Let's look at the Magnificent Seven and Friends, the mega cap growth stocks. Broadcom having a pretty decent bounce higher on Friday. Friday Broadcom was down a lot, but it actually held swing lows pretty well around 325. You can see on the little preview chart, sort of got down to the lower end of that, the last couple of weeks here. So a nice bounce higher for Broadcom today, up about 10%. Which is a decent rally. Traded up to around 360, closed around 357. So that's pretty encouraging. Tesla again bouncing higher. This is what you're going to find with most of these Magnificent Seven stocks. They sort of had a big drop into the weekend, having a nice rally today. And the question is, do you see something beyond just today's bounce? And that's why we call it a dead cat bounce. It's a horrible metaphor for what's happening with the markets, right? You have this big sell-off, the dead cat bounce implies it's just like a natural bounce higher, but the cat is still no longer with us. The market's going to continue to go lower. That's the implication of a dead cat bounce. You find out that that's the case after this day one kind of bounce, and if you just resume the downtrend, that sort of reminds you that things are not particularly getting better. So for now, I think it's sort of wait and see mode with some of these charts to see if they recover. But I'm noticing, one of the things that I'm noticing as we're looking at the complexion of the day today. Look at Apple, and again, I know this is like a little preview chart, but look at Apple. You can see. While we opened higher today, we closed below today's open. Same with Microsoft. So 2 of the big technology names, we didn't really get a great recovery today. It was sort of like the gap higher at the open, but that was it, right? Apple just sort of sold off from there. And I'll show you what I mean here, right? Here's the chart of Apple. Here's just the last couple of days, right? So, we opened here, we traded down a little bit. We went back to today's open midday, but then rolled off. So that doesn't, to me, speak to a bunch of, really optimistic buyers getting back in. I mean, we didn't really make it above today's opening trade. And so that really speaks to a little less optimism than maybe the daily returns would imply. When you look at something like Apple slightly higher today, I mean, it was up a lot more and really rolled over in the afternoon. I think that's good for there. We'll go to the heat map here. As a reminder, I can see the questions coming in on YouTube, on X, on LinkedIn, on Facebook. Thanks, those of you tuning in live. Thanks for asking questions, making it interesting, keeping it interactive. As a reminder, by the way, before we get to the heat map here, I'm going to be at the Money Show in Orlando. Hopefully some of you will be attending. Should be good in this day and age of everything feeling remote at times. Getting together old school and talking and shaking hands and talking about the markets, talking about decision making makes it really interesting. And so please, if you're going to attend the Money Show, let me know, and would love to meet you in person if you're going to be there. We're going to have an exhibit in the exhibitors hall, whatever they're calling it, and working at kind of an interactive display, an interactive experience. So if you do come to the show, make sure you swing by my booth, wherever it will be located, and hopefully there's something cool for you to do. I'm kind of working on that between now and Thursday morning when I have to have it ready, but I have a pretty good idea of how we're going to structure it. All right, let's look at the heat map here. Obviously, so a decent amount of green, particularly in growth sectors, right? In the upper left, we have technology. We can see NVIDIA, obviously up about 3%. Other areas of the market that were getting absolutely destroyed on Friday, having a bit of a rebound, particularly semiconductors stand out. Charts like LRCX and others were selling off pretty good, really through the course of last week. KLAC and others, it wasn't just Friday. Those have actually been selling off through the course of the week. So a nice bounce today. But again, I think the question is, as this week progresses, do you see a resumption of this rotation to the downside? For today, save Arista Networks, which pulled back pretty good today, just over 4%. Technology generally pretty decent. Within communication services, Alphabet up about 3%. I did grab that chart because it's a potential bull flag pattern, which would be, talk about a nice resolution to this sort of pullback into October would be a breakout confirming a bull flag pattern. I'll show you what I mean and what that might imply if we get further strength in Alphabet. Meta pretty good. Outside of those two big names, not a great day for communication services. Financials stand out to me because earnings season kicks off this week. We don't have any economic data really coming our way these days because of the government shutdown that does not appear to be anywhere near over anytime I check on the news. I don't know when that's going to be done any more than you do, but I'm just mentally prepared for an extended period where we don't have a lot of economic data. And I think what that means is it probably magnifies the importance of earnings releases over the next couple of weeks, because that's going to be the only data we can parse through to really understand how companies are thinking about potential inflation, any tariff, with the tariff headline that happened on Friday. Is there renewed, discussion about tariffs and potential impact, interest rates, all of those things. What are they doing with forward guidance? That's going to be as best as we can to get our head around, inflationary pressures, consumer sentiment, those things we would normally look at economic data like CPI and PCE and all those sorts of things. We're going to have to look at, just see what companies are telling us as they report on their quarterly earnings. Earnings season starts this week with a bunch of banks, financials like JP Morgan, Citigroup, all starting tomorrow. A lot of those charts are up today, so you can see like JP Morgan having a decent bounce off of the 50-day moving average, off of $300 a share. This might be a key one to watch here, because if the market's good from here, you would expect a JP Morgan to start holding the 50-day moving average. The problem is a lot of financials are not particularly doing that. AXP actually broke its 50-day on Friday, back above there today. That's good. Citigroup broke, a lot of stocks kind of broke down last week, and either bouncing back above the 50-day, trying to do so. So, this week's earnings, that's going to be probably the story, right? Is whether they are able to recover above there. JP Morgan in particular is usually a bellwether in that general space that I would follow. It's probably one of the better charts, making a nice consistent pattern of higher highs and higher lows. Pulled back to the 50-day, RSI holding the 40 level. That's still a pretty good chart until proven otherwise. So definitely we'll be focused on the financial sector. Through the course of this week, we'll try to highlight interesting charts related to earnings, but a bunch of these names are all reporting. Many of them have pulled back so far in October. And the question is, do earnings provide a reasonable catalyst to propel these stocks a little bit higher? Outside of that, obviously, offense over defense, kind of the story. So the weakest sectors you see here are things like utilities, consumer staples, healthcare. And while we have been seeing some constructive moves in things like biotech and others that have had nice recoveries, today a bit of a pullback to that theme, as some of those stocks that have been doing well pull back a bit as we have a mean reversion day today. I mean, and again, even with all this stuff happening, even with Friday's sell-off and everything, Caterpillar's still making, a new closing high today. So things are working out there. And so, as a trend follower, I'm still not struggling to find charts making decent, still making decent uptrends. That's why watching some of these lagging indicators, trend following devices to see if they break. I think that's the approach that I've learned. I'm seeing some things break down, but still largely okay, despite mounting evidence that we have a major top to get our head around. We'll see that when we look at things like the Hindenburg omen in a moment. All right, let's finish off looking at some charts. I see some interesting questions coming through already. I'll take a question or two before the end of the episode. As a reminder, given the fact that I'm traveling at the end of this week, Wednesday, Thursday, Friday, boy, I'm not exactly sure when I'm going to be able to do a market recap, but I'm going to try to do it. And I'll probably, at the very least, record a quick market recap video and post it to my YouTube channel. Given the fact that I'll be at the Money Show and doing a lot of interviews and things like that, I'll have to pause the daily live stream to accommodate for that. But I will be getting a video your way when I can. So keep an eye on my YouTube channel for sure. All right, S&P 500. Here's what happened, right? So Friday we sold off. We literally got down almost to the penny, exactly to that line in the sand that we've been talking about. The way that I like to approach a market like this, when we're in an uptrend phase, is to assume that the market is innocent until proven guilty. To assume that this market's going to keep working, and just determine what would tell me that that's no longer the case. And I kind of honed in on 65.50 as being the key level. I've had previous lines in the sand that have been, not been touched, and we've just sort of made new highs. And so every time we keep making higher lows, I'll keep bumping up that line in the sand. That's what we do in a sort of a nice classic uptrend environment. Most recent line in the sand is 65.50. We traded right down to there on Friday. So my general thought was, boy, that was a big down day, but not enough to really get too nervous. And as always, right, you don't want to overreact to one day. However, right, 65.50, now it's the 50-day moving average. It's the swing lows, now 3 of them over the last, month. So certainly feels to me like a break below 65.50, more and more seeming like a very negative development. Hasn't happened yet. We'll keep an eye on there certainly this week. Now, breadth conditions, as we've talked about, have been fairly weak, depending on where you look. The McClellan oscillator is probably the most short-term breadth indicator that I have as part of my normal toolkit. Every day I'll look at this indicator. This literally, basically is looking at the slope of the advanced decline lines and just seeing, are they starting to rotate higher, starting to rotate lower? And the fact that the McClellan oscillator has been below zero for about 3 weeks now just basically speaks to the fact that there hasn't been a lot of accumulation in terms of breadth expansion that would be a real sign of encouragement at this point in the cycle, right? For a trend that has been in place this long to continue higher, you need a broad advance. Generally more stocks participating in uptrend. You need an expansion in new 52-week highs, those sorts of things. Here I'm seeing the opposite. I'm seeing less 52-week highs. I'm seeing slowdowns in breadth indicators. I'm seeing the advanced decline lines break down through their 50-day moving averages. The McClellan oscillator remains below zero. That gets back above zero. I would get excited about that. It's not there. Breadth here at the bottom, the percent of stocks above their 200-day moving average, still just fine, well above 50%. Percent of stocks above their 50-day moving average, not fine. The Friday sell-off put that indicator below 50% for the first time since the beginning of May of this year. So coming off of the April low, we finally had enough of a recovery that these indicators got back into positive territory, getting back above 50%, while the long-term breadth is still fine and that most S&P stocks remain above their 200-day moving average. Here at the bottom, we can see most stocks are now below their 50-day moving average. We've been seeing a general decline in this indicator with every major new high since the end of June, which for me is sort of that leading indicator telling us we're probably nearing some sort of market top. Now, when it gets below 50% for me, that's a major red flag, telling me most stocks are breaking below their 50-day. That implies that willing buyers are not just jumping in and buying into a pullback, but rather, starting to break down and fail to hold support. I think that's a problem. The more that this stays below the 50% level, the more that I think this is a concerning market environment. The Chaikin money flow is a measure of volume, and I want to compare this to the price here. So the Chaikin money flow is a way of looking at volume. As you probably know, if you've watched my work for any period of time, I'm not big on volume indicators, not the primary thing that I would use, although I do have some volume that I look at in different scenarios when I think it's appropriate to do so. I watch things like the Chaikin money flow because what they do is they look at the trend in volume over time. Instead of just looking at the daily volume reading and thinking what that might imply, it actually looks a little bit deeper and looks at how the market is changing and the volume implied and what the movement in price relative to the volume shifts suggests about accumulation or distribution. And when the Chaikin money flow is above zero, that means we're in a period of accumulation, stronger volume in up movements than down movements. If the Chaikin money flow is below zero, that tells us we're in a period of distribution, stronger movements on heavier volume, right, to the downside. So what's happened is the Chaikin money flow has been above zero almost entirely since late April. We had like one day in June where it went net negative, but other than that, it's remained above the zero level. But one of the things that I've learned about this is to look for divergences, and I've highlighted some of these divergences. This is one I missed right here, going into the peak in June. When the market's going higher and the Chaikin money flow starts to diverge a bit, it implies that we're starting to see days of distribution. We're starting to see heavier volume in down days that might be suggesting a bit of distribution. We can see that just looking at the raw volume data here. Red volume bars are down closes, black bars are up closes. So we can see some heavier volume on some big down days. Obviously, that's last Friday with the big spike in volume. But it's more nuanced than that because it actually looks at where we close relative to the high and the low every day. So it's looking a little bit deeper. Chaikin money flow is still technically above zero, which means it's still okay. Still saying we're in a period of accumulation, but the very bullish readings we had through most of September into the beginning of October now subsiding, and this is a lighter sort of volume deterioration here. So certainly something to monitor. All right, the Hindenburg omen did indeed fire on Friday. I actually got a question about this, and at the time, it didn't look like it. This indicator is the inputs to the indicator are shown on the chart here, and I'll just briefly describe what they mean. At the bottom, there's an indicator called what I'd call a composite indicator that Stock Charts manages. There's just a lag between them gathering all the data and formally changing, and I think I just got caught up in the lag because it wasn't updated until late Friday after the close. Actually, might not have been updated till today. I didn't look over the weekend. So the McClellan oscillator, oh Lord, the Hindenburg omen, that is a classic kind of macro technical indicator. There are indicators like this that don't fire often. They actually fire very rarely because they're long-term indicators. And there are a couple others like the Titanic syndrome, like the Kopic curve. A lot of these are based on weekly or even monthly data. So they're not meant to like signal all the time, like some technical indicators like MACD is meant to just like give you all these swings. This is an indicator that signals very rarely, like, I mean, maybe once every year or two. But when it does, I've learned, pay attention because this is something that signals rarely, but it's often a pretty powerful signal when it does. The Hindenburg omen has three components. Number one, the market needs to be in an uptrend. And number two, you need to have a bunch of new highs and a bunch of new lows. Number three, breadth needs to turn negative. Let me go through each of those briefly so you kind of understand what happened here. So first off, we look at the rate of change of the New York Composite Index and different ways that people have learned to do this. But what we're using here on Stock Charts is the 50-day rate of change needs to be above zero, meaning the New York Composite Index needs to be higher than it was 50 days ago. Which it has been. This black line is well above the zero line, this dashed dotted thing here. So check one, yes. Number two, you need a certain number of new highs, at least 2.5% of the NYSE listings making a new 52-week high, and at least 2.5% making a new 52-week low. The guy that created this indicator looked at a bunch of market tops, and he realized that one of the things that often happened would be a bunch of things breaking out and a bunch of things breaking down on the same day. It wasn't just a bunch of things breaking out like a blow off top or a bunch of things breaking down like a big sell off. it was indecision that was one of the best indicators of a major top. So at least 2.5% new 52-week highs and at least 2.5% new 52-week lows. And we can see there, we just barely checked that box on Friday because we had enough 52-week lows and still enough 52-week highs that triggered. Finally, the breadth needs to be negative, which means the McClellan oscillator needs to go below zero. And that indeed happened, earlier this last month, as we talked about on an earlier chart. So those three things happen. That means this indicator at the bottom goes to +3, meaning all three of those requirements were met. But here's the other part, right? Sort of the meta part of this is that the Hindenburg omen, to have a confirmed sell signal, needs to have two of those combinations to happen within 1 month, right? So within 20 trading days, we need to reset the indicator and have another, another Hindenburg valid signal. And so what that means is now the clock has started as of last Friday. We've got until mid-November to have a second signal. We'll be looking for that. The last two times we've had a confirmed Hindenburg omen with two valid signals within a month. Last time was in December of 2024. Ended up being not too far before the February 2025 significant peak. The time before that was in December of 21, January of 2022, leading into the 2022 bear market. If you look back, if we looked at deeper history, you can find a lot of major tops where this combination of Hindenburg omen indicators have fired. We'll keep watching this. If we would get a confirmed Hindenburg omen in the next couple weeks, that would be the most bearish thing I could share with you, because I've learned bad things tend to happen soon after you get one of those valid sell signals. If you have questions, of course, please share them on our YouTube channel, and we'll maybe create more videos digging into that particular macro technical indicator. All right, to finish off here, the VIX spiked above 20 today, back below 20, around 19. The last time we had a spike above 20 was at the end of July. We had another similar kind of, multi-day brief spike above 20 in June, and again in May. Those ended up being fairly buyable pullbacks within the uptrend. The problem is when we remain above 20 and continue to push higher, that's when you probably have a much deeper corrective move in play. So I think as the days go on this week, if the VIX pushes back above 20, that would be a huge red flag. At this point, it's an initial red flag, still okay. Gold continuing to be in a primary uptrend. This is the GLD making new all-time highs today. The GLD above 375 all day today. Spot gold above $4,100 an ounce. The uptrend in gold remains quite strong. Number of reasons for this: weaker dollar, hedge against inflation, safe haven, diversifying away from other things, diversification into hard assets. All those things are, just helping gold continue to accelerate higher. I might be interviewing Peter Schiff at the Money Show now that I think about it. I hope so. He's about as bullish on gold as you're going to get. I interviewed him last time, and it was like back here. So I can't wait to hear the victory lap that I receive when I ask about gold now. And I'm assuming he's still going to be pretty pulled up on it, but we'll see what happens if I can interview him at the Money Show. How do you think of an uptrend like this? Again, for me, I think it's bullish until proven otherwise. The chart's going up. Any trend following device I would use. So here I'm looking at the 21-day EMA. We haven't touched that since August. I have the chandelier exit system, which has remained constructive. So any trend following devices are still good. In a primary uptrend, I am not a big fan of selling when we're up a little bit because I early in my career had way too many times where I would do that and then just sit there on the sidelines, just absolutely frustrated when that trade would just continue to work and I was no longer playing it. So I learned to remain engaged with an uptrend as long as it continues to go higher. So as a trend follower, higher highs and higher lows, that's still the play. Bitcoin did rotate lower, so it's rallying, from over the weekend, Sunday now into Monday, back to around 116,000. But Friday into Saturday, it did get down just below 106,000. You can see that a 38.2% retracement. If you take the April low and we get the October high, 38.2% retracements around 106,400. It's pretty much almost exactly where we pulled back to on Friday. We can see that that's also a test of the 200-day moving average. So, for me, it certainly looks like the chart of Bitcoin is developing a pretty consistent floor, sort of in that 106 to 108,000 range. That's been a lot of the major lows here recently. Also, cryptocurrencies as well. If it does not hold that support, if the RSI fails to hold 40, I don't think you can call that a constructive trend anymore. I think that would be a pretty negative trend. For now, it's holding that key support okay. Here's the weekly chart of Apple, and I just do that because we'll talk about some short-term charts here, but I just want to remind you, I mean, that if this ends up being a significant top for Apple, I think we will look back and talk about what an obvious double top pattern this was. And I think that means two things. Number one, expecting resistance around 260 makes a ton of sense because that was the peak in December of 24. That was the peak in September of 25. And now we've pulled back from that level. Number two, it means if and when we finally break above 260, that would indicate a very constructive follow through to the upside as we finally break above resistance. For now, the weekly chart is showing a double top until proven otherwise. Alphabet's an interesting one, right? So Alphabet has broken below the 21-day EMA. It's broken some initial sort of levels of support. We broke the swing low from the end of September. What I'm doing here is drawing what's called a bull flag pattern. Really here, it's a potential bull flag pattern. When you have a big run higher, and then you have this short-term kind of counter trend move of lower highs and lower lows, this becomes a very bullish pattern if and only if we break above the upper trend line, right? So this is basically tracking a parallel decline off of the high around 255. Alphabet gets above 250. That's a positive resolution. We get follow through. That would be a really significant uptrend because it was implied that this flagpole would lead to a parallel move beyond there is how you traditionally use that pattern. I don't know if I would trust that upside objective, but I would definitely say breaking above 250 would be a very positive development for Alphabet. We'll see if that happens here in the days and weeks to come. But that's something I'm watching here. All right, lots of fascinating comments here. Let's see. Yeah, I see the comments on plenty of crypto coins. Well, I don't know about crypto coins down 50% on Friday. Altcoins are a dangerous thing to be playing with on a good day, and definitely not when bad things when things happen like Friday. The problem with a day like Friday is there's such a significant move that certain things are just not kind of battle tested with that sort of significant move in mind. And we haven't had big multiple percentage days often since the April low. And so that's something to think about. All right, 3P investor, thanks as always for watching. You said, why would we not look at all-time high point in gold as 100% and work out the retracements instead of looking at the low point? Oh, I see there's some comments coming in about measuring a potential top in gold. Yeah, I see some of the comments about looking at gold. Yeah, so here's the thing, right? When you're looking at something like gold, let's bring up the chart. Here's why I don't look at retracements on something like gold just yet. Retracements make sense if you assume that that's the high, right? So if I say, all right, I think today was it. I think that's the end of the move. Could we use today's high and project some potential support? For sure. And short-term support levels, I would probably take, this sort of low, and I would take that high and say, all right, here's some potential pullback levels using that as a framework. But that's assuming that today is the high. And I don't know about you, but I'm not ready to declare that to be the peak. I mean, could that end up being the peak? Yeah. But am I seeing anything today saying 4109 and change is it for this uptrend in gold? I'm not. I'm seeing more a trend that's going higher. So instead of setting, all along the way, kind of picking each new high and setting new retracement levels, I wait for a peak to be established, right? Once you have that initial sell-off, then you can be going back and saying, all right, well, that's the peak now. Now that I know that peak, and then some level back here was support, and now I can use that to sort of identify some support levels. You need to establish the high, right? And that's why I always talk about a Fibonacci framework, right? You need to have a clear low and a clear high. So if we're in an active uptrend, I don't really put retracement levels until we get that initial sell-off. And the way to think about it is, all right, we've had the initial drop. Where might this drop find support? Where could I identify some support levels? That's when I would use something like Fibonacci retracements. When we're in an active uptrend, it's not as helpful as you'd want to do it. Now, there are Fibonacci tools that are meant more to project price targets, things like Fibonacci extensions, a lot of times they're called, which is really derived from Elliott wave, where you take like an initial move and then project that framework higher. You can do what's called Fibonacci projections, which says, all right, this is 100% of the move. What's 138% or 162%? I don't use a lot of those tools in my own investing, mainly because as a trend follower, if something hits some arbitrary upside target, I'm generally not going to want to sell it. I'm going to want to keep following things, even if they go further. And so that's why I wouldn't pay as much attention to those. Some people enjoy those, and more power to them. William Brewster, thanks for watching on LinkedIn. You asked thoughts on the number of stocks that had inside days today. Thank you so much for highlighting that. It's not hard to find a bunch of stocks with inside days because so many of them had them. Of course, now that here we go. I was going to say, now that I said that, I couldn't find a good example. Yeah, so inside days and outside days. These are basically built from bar charts, very similar to some candle patterns we could talk about. But inside days are basically when the range is compressed, right? So day one has a big down day, for example. Day two, inside day means a lower high and a higher low. We have a down close and then an up close. Inside day is a bullish reversal pattern using bar chart methodology. It's built on the premise that the big down day and then the narrower range, but an upward move sort of implies some short-term optimism, pushing things higher. Suggests the next 1 to 3 bars probably more likely higher rather than lower. That's totally fair, and you'll find that with a lot of those. What strikes me though is if that's what KLAC, like some of these do have a narrower range, but they actually close below the open. And for me, that's actually more of a negative sign. I'm less encouraged by the fact that you're seeing distribution through the course of the day. Kind of mixed results on that. So you are seeing a lot of inside days in a lot of places. The problem is very, very common after you've had a huge uptrend, an initial sell-off, as we mentioned at the beginning, that kind of counter trend rally, which a lot of people usually describe as a dead cat bounce, potentially what we're seeing with those inside days as well. All that means is the remainder of this week is going to be pretty meaningful. Anytime you have that initial sell-off, you have the recovery day, which we saw today. Does that recovery continue? We're going to have earnings to deal with, probably more headlines of some sort that we haven't figured out yet, but we're here with you along the way to update you on the charts, to share key signals and key actionable moments, and to answer your questions. So I will say thank you so much for watching today. Thanks for joining me here on the show. Go Mariners. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.